Good afternoon, everyone. By way of introduction, my name is Hugh Wedlock, and I'm Director and CEO of the Fry Group here in Singapore. And I'll be your host for today's Global Investment Briefing. Now, it's clear that this year, 2022, could turn out to be a very important one from the perspective of the global investment markets. We appear to be moving into an environment where inflation is much more volatile. Some parts of the investment market remain distorted by the policy response to the pandemic, and it seems likely that the macroeconomic policies of the world's most important central banks will change to at least some degree. So today, we're going to discuss all of these factors and more. We've got two speakers today. The first is Charlie Buxton. He's one of the Fry Group's portfolio managers based in Hong Kong. And secondly, Gary Dugan, who's CEO of Purple Asset Management here in Singapore. Now, we're going to hear them present for around 45 minutes, and then I'll be back to facilitate Q&A and wrap the session up. And all told, we're expecting the session today to last around about 1 hour and 15 minutes. If you have any questions in the interim, please use the Q&A box, which you will see at either the top or the bottom of the Zoom page. Now, before I hand over to Charlie, I'm just going to try and get your grey cells working a little bit with a quick poll, which should be coming up on your screens any moment now. So I'm hoping you can see that in front of you. Now, our poll question is, what do you think will be the best performing index in 2022? Is it the S&P 500, the US equity market, emerging markets as measured by MSCI, or the FTSE 100? I can see you're all thinking quite hard about this. The numbers are still moving around. So the numbers have stopped moving. I'm gonna end the poll. And the results are as follows. So S&P 500 is the leader at 43%. EM second at 35%, and FTSE, a real laggard, coming in third at 22%. So assuming that there's quite a few UK expats on this briefing today, there's absolutely no home team bias being shown there. So let's see if our speakers today agree with our opinion there. So without further ado, I'll hand over to our first speaker today. And that's Charlie Buxton, who, as I said, is one of our portfolio managers based in Hong Kong. Charlie, it's over to you.
Great, thanks you, and good afternoon, everyone. Now, I'm just going to begin by outlining the different investment strategies that the Fry Group has on offer for our clients, and then I'll spend a few brief moments just outlining our own approach to investment management. Before I do, though, it's worth just saying we are entirely independent in how we invest and are not tied to any third-party provider. So we offer a truly whole-of-market solution. Now, we offer a range of services across active, passive, and ethical, or ESG, environmental, social, and governance investing, and that depends on our client requirements. But I should say that it is multi-currency, so across sterling, dollar, and euro. In terms of our advisory offering, as you'll see at the top there, this is the clients that essentially want a little bit more control with their portfolios and just want to consult or be consulted by their advisor every time we recommend a change in fund selection. And then beneath you there, you'll see a range of our discretionary solutions. Now, these range from strategic to tactical model portfolios to those that are fully tailored to the client. Now, the Fry Group offers a medium to long-term strategically positioned portfolio offering, and that's something that I'll come on to in more detail shortly. We also have models offered by Purple Asset Management, that's run by Gary and his team in Singapore, and that combines both strategic and tactical investment. And then finally, we have a range of fully tailored discretionary portfolios from a variety of third-party global investment managers. But I'm just going to spend a few brief moments talking about our own managed portfolio service and how we approach investment management. Now, we already have this in place for our Hong Kong, Dubai and UK clients with a track record that goes as far back as 2017, and we'll shortly be introducing this to our Singapore clients too. So in terms of our how we approach investment management, we look at it very much on a strategic basis. So long-term strategic asset allocation. And what we believe in is a portfolio based around strong diversification. And what you'll see in front of you there is ways in which you can diversify the portfolio. So obviously asset class being a key contributor to that, but it's also important to think about the regional allocations, the style, so how you blend different third-party managers and the strategies, and then sectors, and of course the type of investment, so whether that's active or passive. Now, on top of all of this, we also apply 3 tilts, which are value, emerging markets, and smaller companies. Now, what I'm going to do just briefly is spend a bit of time on one of those 3 tilts, which is value, just showing you some of the empirically backed data that sort of backs a long-term tilt to value. So on this next chart, what you see in front of you is the performance of a Russell 1000 value index. So this is 1,000 of the large and mid-sized companies in the US, value companies in the US, relative to the FTSE All-World, so a global benchmark. Now, what is value investing? Well, essentially it comes down to stocks which trade at a discount to their fundamental value. Now, this can be identified by a range of metrics, typically price to earnings or price to book. What it really boils down to is how that stock trades relative to its balance sheet. And as I say, this first chart just shows you over the last 30 years, the outperformance of large and mid-cap sized value companies over a global benchmark, the FTSE All-World. But you could actually chart this chart all the way back to the 1920s and you'd still see similar levels of outperformance. Value typically outperforms in a higher interest rate environment, since value stocks typically have less reliance on borrowing, and therefore they're less impacted in a rising interest rate environment. Now, because growth stocks typically rely on longer term gains, they suffer more from the discounting effect of rising interest rates. And that's something that I'm sure Gary will come on to later on. In terms of our next graph, you'll see just the shorter term underperformance actually of value. And that's because basically since 2008 and 2009, we've been in a low interest rate environment. So central banks globally have flooded the market with lots of liquidity and have kept base rates at relatively low levels. Now, this has helped the performance of growth stocks, and that's what you see in front of you there. But as I say, we're now entering an environment where the narrative is shifting somewhat. Hugh mentioned inflation earlier. That is clearly the topic of the day. And as the year has started, we've seen more of a pro-cyclical rotation away from growth stocks and into value. And our view is that that will continue given the wide disparity in valuations between value and growth stocks. So just final couple of slides now. What you see in front of you is the performance of our most popular strategy, which is the TFG UK Growth Balanced. Now, this is benchmarked against a peer group benchmark. So essentially, asset risk consultants, who are third-party risk managers, they compile data from around about 100 investment managers in the UK, and then they aggregate it into a benchmark according to each risk mandate. And that's what you see in front of you there, that our growth balance strategy has outperformed our peers dating back to 2017. And just finally from me, ethical investing will no doubt be touched upon later on, but it does just show this is our in-house ESG strategy, again, a balanced mandate, but does just show the outperformance of that strategy relative to the peer group. So essentially, it just identifies that you don't have to give up returns in investing ethically. So I think that's illustrated quite well there. But interested to hear Gary's views. And with that, Hugh, I'll pass back to you.
Thank you, Charlie. Thank you, Charlie, for that. Very interesting over the last week or two, following the last week or two, to get a reminder of the value of strategic long-term asset allocation as a driver for returns. But I think the important thing from our perspective now is to get an update on 2022 and what we think is going to happen there. So it's over to Gary Dugan, CEO of Purple Asset Management, to deliver that overview for the coming year. Over to you, Gary.
Thank you very much, Hugh, and hi everyone. I'm glad to be back in front of you, obviously in trying market conditions since the beginning of the year. So it's my intention over the next 30 minutes to probably be more focused than I normally am. I normally try to cover as much as I can in terms of topics, but clearly top of the agenda at the moment is the increase in inflation that we've seen, clearly the wobbles in the market, and what does that mean for the full 12 months rather than just the first 3 weeks of the year. And also just give you some direction as to where the long-term picture is moving. And as I'll explain in a few moments, we've seen some very distinct periods over the last 30 years. And I do think that the next 5 to 10 years could look very different to what we've just perhaps enjoyed, but certainly witnessed over the last 30 years. But just to set the scene, I just wanted to start with a poll, just to kind of gauge the mood of the audience, particularly in terms of the outlook for interest rates. So we're going to ask a question about UK interest rates. Just as a marker, today, UK interest rates are 0.25%. Remember, they were increased at the last meeting. So where do you expect UK interest rates to be at the end of this year, 2022? So just make a single choice, 1% or less, 2%, or 3% or more. So I'll leave that for you to vote on from now. Okay, and there comes the result. So let's just say it's pretty balanced between interest rates, quite frankly, remaining about where they are. So we're at 0.25, but 1% or less is still a very low number. And only 15% expecting interest rates at the end of the year to be above 3%. So, I mean, I'll just give you one little statistic just as by way of closing on this particular topic, but the average of UK interest rates since 1971 through to the end of last year has been 7.2%. So I think we're very, very anchored on our experience of the last 10 years, but if you take a much more extended period of time, interest rates were far higher. And I remember to my cost seeing my mortgage rate going up to 17% at one point in the past. So anyway, putting that to the background, let's now discuss some of the longer term trends. Perhaps Hugh, if you could turn to the first slide, you'll see what we believe to be, I would say the two most significant trends of recent times, changing back to 1982. And I'm going to contrast that with where we find ourselves today and how different market conditions could be, certainly from the period from 2009 onwards. What I really don't want to get people come away from this presentation thinking is just about the next 3 months. I really want people to understand where we think the macroeconomic conditions will be for the next 10, 15 years. So if you go back to 1982, which is quite frankly when I first started work in the City of London, I remember, everyone talking about Volcker, high interest rates, and really what we enjoyed from 82 onwards was the central banks getting control of what at that point in time was extremely high inflation and very high interest rates. And the benefit of bringing inflation under control was the global economy, particularly in the developed world, saw some of the most consistent, continued growth. Now, we had our wobbles in the markets. I remember trading in 87 or at the peak in 2000. But broadly, we had strong corporate profits growth, which was helping the returns on equity markets. And we also saw that, of course, falling inflation meant lower bond yields, and lower bond yields meant good capital gains on bonds over that entire period. Now, unfortunately, the world went a bit crazy in that period between 2005 and 2007, where we started to get a whole series of imbalances in asset markets that were very, very expensive. And we saw a massive correction leading to the world financial crisis. Now, we've been in a very different environment from 2009 onwards. I think, unfortunately, a lot of people have assumed that that was a quality period, so kind of got used to some very good returns. But I would say they were far lower quality than we had in the period of 82 to 2005. So what were the main points I'd make about the most recent past? Well, firstly, we ended up with negative inflation because of the global financial crisis. That's not a good outcome. We've had inconsistent growth, but we could have convinced ourselves it was very good because some of the numbers have been extremely high. But they've all been achieved by and large with some of the most extraordinary policies of both government and central bankers. Now, it began with central bankers, but when we got to COVID, it became government. So what were the actions of central bankers? Well, we've had an emergency policy amongst central bankers defined by them alone for 12 years. So I would not call it emergency. I would actually, quite frankly, call it inappropriate. We've had unnaturally low interest rates. We've had governments buying up almost, in many countries, all the government debt. So, for example, the European Central Bank has been buying about 90% of the new issuance of German bonds. Quite frankly, why does the German government need their bonds buying by a central bank of Europe? And of course, that's just encouraged governments to spend more and more and more and get into enormous debt. So whilst we've enjoyed some tremendous asset market returns, for those of you who have heard me speak before, I was just always concerned that this was not well-founded and that there would be some kind of day of reckoning. So I think we've got, within this significant increase in inflation, we do have challenges going forward. It doesn't mean the end of the world, but it means that things are going to be more difficult than they were between 2009 and 20. And I still don't believe it's going to be of the quality that we saw from 1982 to 2005. So Hugh, up to my next colourful chart, which is, I'm sorry to say, very, very red. But one of the consequences of government policy, particularly during COVID, but was also the case prior to COVID, is that governments have continued to accumulate huge amounts of debt. So the picture you see in front of you is the debt to GDP ratios of most countries in the world. And if you look in the core there's lots of emerging countries, but there's lots of grown-up countries as well. Of course, everyone knows about the debt of Japan, but debt to GDP in France is 115%. The color coding is that the academics will tell us that there's a sustainable level of debt and there's an unsustainable level of debt. So everything colored red is by definition, according to the economists, unsustainable. And the only countries that have sustainable levels of debt are grouped around the circle that you see there. And you struggle to find any grown-up big country in most of the countries that you see around the edge of this chart. So, I mean, you can come back and look at this at your leisure. But the point I'd make is that the world has built up a huge amount of debt at government level. And therefore, if we have another crisis, in a sense, the governments have really not got a huge amount of flexibility to spend more money than they're bringing in the future. So that's going to take away one of the very easy drivers, or one of the significant drivers of growth over the last decade. So on to the next point, and now I want to just get into giving you some quite significant detail on the inflation outlook, because this is absolutely crucial to where markets move over the course of this year and into the future. We've enjoyed for many years the period you see here from the 1982 that I referenced earlier, that we had the falling of inflation, particularly in the United States, and we've had very consistently, generally low inflation for much of the last 2 to 3 decades. And the fall in inflation allowed bond yields to come down. When bond yields come down, companies and governments can fund themselves more cheaply. And that allows for a cycle of capital investment and good news. Unfortunately, this policy was exaggerated when we got it into the most recent times. So finally, people were spending so much money that it actually started to create inflation. And that inflation, quite frankly, as far as the central bankers are concerned, is now out of control. Because if you go back to about a year ago, the presumed peak in US inflation was supposed to be below 4%, and instead we're hanging out there above 7%. A country like Germany, it's supposed to never have an inflation problem in the future, has now got an inflation rate well above 4%, as is the case in the UK, at an inflation rate approaching 6%. So how long will this inflation hang around? Is it transitory, as the Fed said some weeks ago, but has now changed its mind, or are we going to have to worry a bit more? Well, there's no absolute 100% answer, but just a couple of things to leave you with today. And on to the next slide. You would have assumed that this peak in inflation or spike in inflation, that maybe the worst elements of it are behind us. But what this chart shows you is the degree to which the inflation news, so the data releases, are coming in above or below expectations. There is no sign of this thing peaking at present. We thought in the middle of last year, or the economists thought that by the middle of last year, inflation would be squeezed out. Consumers are not going to spend, are not going to pay up. Corporates are not going to pay up. We're going to see a peaking in inflation as demand pulls back when prices are forced higher. Instead, we're seeing quite the opposite. And part of it has been because there's such substantial support provided by central bankers and governments that people have felt flush with money. They've been making substantial gains in the markets and have therefore used those gains and income growth in order to continue to buy products which have gone up in prices. And therefore those price increases have stuck, and there's been some more coming through. So what are the main factors for the future? Well, on the next slide, I've got 4 bullet points to keep in mind. Firstly, a good element of the inflation we're seeing today is supply disruption. So with COVID closing down ports or closing down factories or making world trade flows dysfunctional, that has led to a shortage of things, and therefore people pay up. And for those of you who kind of follow second-hand car prices, you cannot get your hands at the moment on a new car when you want it. And therefore you think, well, I need to upgrade, so I'm just going to go into the second-hand car market. And we've seen some very substantial increases in second-hand car prices, again, because of the supply disruption. Secondly, we're starting to see some signs of wage inflation. So minimum wages have been increased in a number of countries. I think call it almost a social policy. You're also now starting to see shortages of staff. A number of people have retired early, and there's many other factors. Women who are not putting themselves back into the labor force, people who are just kind of quite frankly giving up. Some that just won't work for such low wages to work 18-hour shifts in an Amazon warehouse. All of these things are leading to more wage inflation than previously expected. But I would say so far that hasn't become a significant pressure, but it is a pressure that we haven't seen for some time. The third element, which I brought up before, is commodity price inflation, which is led by the greening of the world. So a lot of the minerals that we need in order to go green, whether it's the things that go into a solar panel or that go into a battery for an electric vehicle, or are used in the turbines that that give us electricity from wind power. All of these things are leading to very, very substantial increases in commodity demand in a very short period of time, and again forcing prices higher. Also, we're seeing that there's been a major underinvestment in the exploitation of new mines of many commodities, and that includes, quite frankly, oil. So it's very, very easy to argue that oil prices will be somewhere between $80 and $100 going forward, rather than the $30 to $50 that we might have enjoyed in the past. And the fourth point, and for those of you in Singapore, you may have already seen this, but rental inflation is back and it's accelerating. And it's not just in the United States, because we've heard that story already. We're seeing it in the UK, we're seeing it here in Asia. And again, it's largely because of the underinvestment in building real estate in the past. There are shortages of apartments, and the landlords are just pushing the prices up. So rental inflation in many countries now is hitting 10 to 15%. And the last point I'd make about inflation is, and this was just a little anecdote from Netflix. Netflix had horrible numbers last week, disappointed investors, but they announced a 10 percentage point increase in subscription rates. And my worry is, you know, having lived through and being a very vivid memory of the 1980s, the inflation, 70s and 80s and the inflation is that we tend to get anchored on a number. So it kind of starts to play out that someone says, you know what, let's push up prices. You don't push up prices by 2 or 3%, you push them up by 10%. And unfortunately, we're hearing more industries and more companies talk about the 10% increase and not the 2 to 3% increase. Now, I'm not certain, of course, in the statement that says it's going to be 10%, but all I'm saying is at the moment, many companies are trying to get very significant price increases through. If they stick, we're going to see a further acceleration of inflation, and a very significant element of that inflation, such as in the United States, where rent accounts for about 40% of the inflation basket for the headline numbers that you see. So my bottom line is, I don't think inflation is going away quickly. There are many, maybe structural reasons why it should come back down over time because of aging populations and many other factors. But for the moment, none of the factors that you see on this page at the moment are going to reverse. They're still hanging around. So on to the next slide. Let's just put some numbers on it now in terms of where could this lead interest rates? Because of course, in terms of groupthink, I think we're saying UK interest rates, let's say between 1 and 1.25% by the end of the year. Well, if you actually look, and these are numbers from JP Morgan, so these are up to date with current global conditions. They're saying the neutral rate of interest in the UK would be around 2%. Now, we don't get necessarily to neutral by the end of this year, so we could still be, you know, in agreement with that number based upon the earlier poll. But just keep that number in mind, because that means that the 10-year bond yield, which today is 1.3, could end up being 2.5, maybe as high as 3%. And even investment grade bonds would then be at 4%, a very big difference from where we are today. So if you just mathematically cast your eyes from right back to left, all of those numbers stack up to some losses in corporate and government bonds as yields move higher, and that's just the UK. Moving to the United States or to dollar-issued securities in the bond market, again, the same analysis, that the cash or the interest rate from the Federal Reserve would be at neutral, and I stress neutral because in order to bring inflation under control, you typically move interest rates higher than neutral, but you're talking about, let's call it a minimum of 2% Fed funds rate, a 10-year bond yield of 3, not the 1.8 we see on our screens today, and quite significantly higher yields elsewhere. So emerging market debt at 6.7, that number would basically say you wouldn't make too much money on emerging market debt in the next 12 months. So let's just look now at, you know, recent trading of the 10-year bond in the United States on the next slide. A couple of points to make: that we think yields have gone up, but they actually really should go a lot higher. The previous slide said that US 10-year yield should be at 3%. And you can see that that 3% would be still very low when you compare it with history, which is the blue line. Now, if you take the 10-year bond yield and you take the inflation rate off it, you know, why on earth would you buy a bond today at 1.8% when you've got inflation of 7? Because your real spending power is going to fall as you've got inflation at 7, but your portfolio is only returning 1.8. So real yields in the United States are still very low. Those real yields very low actually is quite stimulative because you're basically borrowing money very cheaply relative to the inflation in the economy. But it also means that if inflation sticks at anywhere close to 5%, the Fed will probably have to do more than the 2% interest rates, and bond yields could easily creep up even to that 3% number that's seen as neutral by JP Morgan. So that's the central banks. Now, what else are they doing? Well, the other thing they're doing is not just interest rates. They've also been doing quantitative easing. What you've seen here is the aggregate value of quantitative easing. So the aggregate bond buying by all those major central banks, so the Fed, ECB, Bank of Japan, Canada, and New Zealand, over the last 7 or 8 years. And you see it in 2007, it was less than 2 trillion, very modest numbers through 2018 and 19. And that's interesting because we talked about quantitative easing for some years, but in 2020 and 21, it went stratospheric. And that was a massive stimulus to the global economy, which is now, it's going from a huge number to 0 and going negative. Central banks around the world are going to stop buying bonds, no incremental increase. So they will continue to just commit the same amount of money, but over time, they'll actually reduce the amount of money as well. So all I'm saying is interest rates higher and central bankers not doing the quantitative easing. This is a very, very different environment for us to be investing in than we've just enjoyed for the past 2 years and previously, but particularly over the last 2 years. It really is going to be very difficult for us to achieve the same kind of extraordinary returns when all of the stimulus of very low interest rates and quantitative easing is no longer with us. So that all sounds like bad news, but on the next slide, I've got some good news. The good news is that there are a number of things with momentum, whether it's consumer spending, whether it's the wage inflation, whether it's companies that still have the ability to spend money on capital investment. But when you aggregate up all the things that different people in the economy could be doing, we could still be generating reasonable, what I would call good growth in 2022. Now, whilst these numbers could be cut back in coming months, it's not bad that when you start 2022, you see a global growth forecast of above 4%. Because 2019 wasn't that bad, and yet global growth pre-COVID was 2.8%. So we're still forecasting, or the economists are still forecasting good growth for this year and into 2023, even though interest rates are likely to go up and governments are not going to be spending as much money, indeed a lot less than it did in the past. Another thing to bear in mind, particularly when you invest in equities, is that when you ask a company how it's doing, it'll say, well, my revenues are growing by X%. They don't think about real numbers, which is what you see here. They think about the inflation component as well. So in 2022, we're going to have real growth, which real growth is the best way of thinking of it is units of things that you sell. And you're going to have price inflation. So a company will be enjoying selling 4% more product with inflation of, say, something like 4%. So in truth, their revenue growth is going to still remain quite robust. All they're going to be worried about is, can I match my revenue growth, or can I beat my revenue growth to beat my input cost inflation? So all I'm saying, as we start this year, we've got more revenue growth than companies have seen for some time. If they can keep control of costs, although there's going to be some pressure, corporate profits will still be growing. If corporate profits are still growing, the backdrop to equity markets is not a disaster. The reason that equity markets fall a long way is either because they're overvalued and or the global economy is going into recession. There is nothing in the forecast at the moment. I don't see any forecasts out there for 2022 being a recession. So let's just aggregate all those things up and just try to come to some conclusions. Rising interest rates, higher bond yields, they're going to limit investment returns. So it's best not to think about 10 to 15% returns this year, but somewhere between, I would call it, 4 to 10%. 10% is a bit of a stretch, but let's say 4 to 10%. And those returns would also include a very modest and negative returns probably from bonds. We are seeing the balance of growth and asset market returns switching away from the United States towards Europe and Asia. So I kind of disagree a little bit with the expected best asset class for next year. I'm not so sure it's going to, or this year, which I'm not so sure it's going to be the US as it has been in the past. And I also think that thematic investment is going to become more important. Yeah. If you think of it, real estate still does well with inflation. Energy companies do well when there's high oil prices. Commodity plays do well when there's upward pressure on commodity prices. But technology doesn't do so well when interest rates are rising. So just to finish on a few just asset class themes to leave you with, what are the kind of things that you're going to look for to kind of ensure or for you to feel that things are still okay? One of the most crucial things for me to explain this chart, the crucial thing is long-term expectations for inflation. Now, currently, those expectations are around 2.5%. If, as we go through this year, people get more concerned that inflation will be sticky at a higher number for an extended period of time, not just 1 year, then what typically has happened in the past, which is what the bars to the right-hand side are showing, is that the correlation, so the connectivity between equity and bond returns will be higher and it'll be positive, which means that the bad news would be that both equities and bonds will be giving you the same directional returns. Remember, we hold equities and bonds for diversification. If they're more highly correlated, you get less diversification, and therefore if bonds are giving a negative return and equities are giving a negative return, it's a bad outcome. So if you see inflation sticky well above 2.5%, you can expect us as active managers in markets to be making changes in your portfolio in order to overcome that. The next point, the next structural point is on the next slide, is that in the past, quite frankly, the only thing you wanted to hold in your portfolio was US equities and US tech, even though quite frankly, that's also carrying a lot of risk. But if you look at the major investment houses, and I give you a grouping here of 5 names, BlackRock, JP Morgan, Robeco in Holland, Europe, Investec, Manulife in the United States. And you look down the column for the US and you look down the column for Europe, even those companies that are based in the United States and typically have had a huge bias, home bias towards their own local market, are saying that the expected return from the US is going to come in well below that of Europe over the next 5 to 10 years on a compound rate of growth. So JP Morgan is the example. JP Morgan said that the expected return from US equities per annum for the next 5 years will be 4% in the United States, whereas for Europe, it's 7.5%. That's a huge difference. And I've never seen gaps between these two major markets of such size. So it kind of wakes you up that maybe your portfolio should not be as focused on the US. And just to remind people that in a general benchmark for equities, the US is around 65%. So there's a huge allocation to the US. Finally, on bond markets, you can see the returns are very modest. I'm just going to quickly wrap up here on just why are returns so modest in the US. It comes down to the US has performed so well that its valuation is too high. So the reason there's a drag on the returns from the United States is that we're assuming valuation goes back to something closer to normal, which means that it'll be a drag on returns. And that's why in the case that you've picked, you see here from Manulife, they say 3.9% return from US equities, lots of corporate profits growth, but there's a drag as the valuation of US equities comes down. And to maybe put a picture on it, which makes it a lot easier to understand why the markets have corrected so far this year, and it comes back to valuation again. So this picture was drawn as at the end of 2021. The blue line shows the performance of the S&P 500, starting at 100. And you can see that this line has gone up, doubling since 2017. But corporate profits have not kept pace with that. And typically, your equity market return is, quite close to the growth in profits. And the gap that opened up is of the order of the 160 to 210. So you need to take 60 points off 210. In very broad numbers, that argues for a negative return or a correction in the US equity market of 30%. Now, this I absolutely do not believe that it happens in a straight line. The way it closes, that corporate profits continue to grow and the market comes back towards it. So Year to date, the US equity market is down about 7%. The NASDAQ is down more than that, 11%. A lot of it comes down not to a dramatically negative view of the outlook for US growth. It comes down to higher interest rates leading to a derating of the US market, closing the gap between the index performance that we've seen over the last couple of years and where corporate profits are. So to give you, again, I go back to Netflix. Netflix fell 20% in one day last week. From the beginning of 2020, that stock price was up 97%, even though corporate profits were only up 22%. The correction has now brought those two numbers back together again. So these things happen. The corrections to valuations happen. And it starts to happen when you disappoint your shareholders, which is exactly what Netflix did last week. So in summary, on the next slide, where do you hide when inflation is a problem? The column with the header inflation shows you some of the fantastic returns you get from commodities, gold, and where you don't get such great returns are the negative numbers. Now, these are all adjusted for inflation. But if you go into your usual places where you'd invest, as you see there, if you've got a serious inflation problem, but equities and bonds will be struggling, and you've got to have very focused plays on industrial commodities, agriculture, gold, to some extent, some of the credit markets, but residential real estate. And so taking a lot of information around the inflation and the outlook, what we would say by way of summary, and then we're going to open it up for some questions, is, you know, it's very easy to kind of get very negative when you see markets fall. But I just want to go back to that point again. There is some good growth around, and it's not going to get destroyed at this point in time, a very low risk of a recession. Inflation is strong, much stronger than we thought. It is going to be a very strong headwind to returns. So don't think 10 to 15% returns. Please think 5 to 10 and how you generate them from markets probably other than the United States, with more bias towards Europe and Asia. And in terms of sectors, and again, these are volatile sectors, so be careful about the sizing of these in any portfolio you construct for yourselves, but mining, energy, and real estate. But I'm going to finish with one last slide that basically just challenges you to buy things that are cheap and not expensive. And we've seen some extraordinary things in 2021. So for those of you who know much about NFTs, it's a new fad of an asset class that people have been buying. Well, there was this artist in the United States. He'd been selling art for some time. The highest price he'd ever achieved for any of his remarkable pictures was $100. And then one day someone got to hear about his art, and the next picture he sold into the market was $69 million. And that was an NFT. And the second picture is that cupboard stroke garage stroke shed in Chicago, which sold for $1 million as the real estate market went crazy. However, and for those of you out in Asia, you'd recognize this. It's a guest house in Patong in Thailand. Of course, Asia's had its troubles, but for $5,800, you could get a guest house. Now, all I'm saying is, I think you've got to just challenge yourself to look at things that are cheap and challenge yourself maybe to unload some of the things that got very expensive, because it's a very bifurcated market. It's a very challenging market, but I hope my comments may have added some thinking points and maybe challenge you on some of your conventional thinking. Hugh, back to you.
Gary, as usual, an excellent update there. I felt, you know, plenty of food for thought, and I think if we did my poll again, we might get slightly less voting towards the S&P 500. But let's see about the questions we've got on that. I hope everyone enjoyed that. We've now got 20 to 25 minutes for questions from our panel. And we've had quite a lot of questions through from everybody who is on the briefing today. So I'll start with a question for Gary. Gary, this is from Colin Buchanan. And Colin says, given the lackluster performance of the FTSE compared to the American exchanges over the past year to 18 months. What plans do you have to direct more adventurous investors towards portfolios with US content, especially with exposure to tech companies? You've just made a little bit of comment there, but perhaps you'd like to expand on that.
Yeah, no, good question, Colin. And there's no simple answer to this. So let me just start with the tech sector. As I said, as we went through the last 2 years, the extremely low interest rates, and also, a stay at home and work from home and all sorts of things, which meant that there was a greater technology content to people's lives, really made it a slam dunk that you needed to be in the tech sector. We also saw a lot of retail money go in, and unfortunately what retail money tends to do is exaggerates valuations. So simple story is NASDAQ went up a long way, earnings didn't keep up with that level of the market, which meant that gap was wholly dependent upon very low interest rates. But as we know, those low interest rates are going away now. And also, we're also seeing that companies like Netflix and others that benefited from lockdowns and stay at home and people enjoying technology content a lot more, that growth rate of revenues over those 2 years couldn't be sustained. And so we're getting some disappointment. So I would say, I think we've got another significant period of the unraveling of the extremes of performance in the tech sector. If I said that something like another 15% off the index would bring us back to fair value, but that these things tend to get exaggerated to the downside before they rebound, I would just say, if you're not in tech, or if you haven't got as much tech as you want, quite honestly, I would start to look for the buying opportunities. And I'll give you one, and this is not a recommendation because I don't want to make stock recommendations, but a leading company is Microsoft. Microsoft last week spent $69 billion on its biggest acquisition in about 40 years. Microsoft is a strong brand name. It can enjoy inflation because you've got to have Microsoft products, and they told you that tomorrow morning you have to pay 15% more for it, you pay 15% more for it. So those are the kind of companies that we would ordinarily want to invest in. If they get dragged down by the negative sentiment in the sector, these are the kind of companies you want to be invested in. But I would say for broad NASDAQ investment at the moment, I do see some further downside risk. So, and I always say it's difficult for me to put up the merits of the tech sector versus good old Blighty in the UK. But I would make one point, and this, I know it's a kind of morass of nonsense and craziness and politically in the UK at the moment, but the government's announcement of a general reopening of that economy, of that country, no masks, this, that, the other, it may be a little bit foolish, we'll soon see, but I really do believe that we are going to get the true reopening trade starting to happen now, where we don't have a reopening and then we have a closure again. Just as a side comment, this virus is now following a very, normal path, strong to start with, starts to wane, and then becomes something you can live with. That's what's happened with all of the major viruses in the past. If the UK has got its timing right, the UK equity market will see a lot of money go in there as restaurants, airlines, and companies in the UK say, we're all back to work, we're generating profits stronger than we expected. That is the kind of momentum of good news that I don't think many other countries at the moment are on the cusp of delivering, maybe later. So I do think there's a period of outperformance in the UK market, but I say that story is very different to the comments I've made about tech.
So thinking about the UK a little bit more, and this is a question for Charlie. Charlie, this is another question from Colin. Will or can the FTSE become more dynamic with regard to appealing to tech and more modern progressive companies as a place to list? Or is it doomed to low single-digit growth?
Yeah, thanks, Hugh. I mean, clearly it's a timely question given the level of returns you've seen from the US stock market, and a lot of those returns focused on tech stocks. And clearly, if you look at the way the UK market is constructed, it does largely comprise old economy heavy sectors, such like industrials, financials. So there is clearly a big weighting to that. And as I say, technology stocks in the US have provided very strong returns to investors in that space. What I would say is, yes, the UK economy is very sort of old school in its construction, But the government has in the last year been making efforts to actually attract new technology companies to list in that space. So I'm thinking about rules relating to SPAC listings. And there was in fact a rule as well last year looking to tear up the one share, one vote, and actually enabling founders more powers when it comes to listing on the FTSE. So that has raised a few question marks with investors, given that they all equally want to have their own voting rights and are concerned about the corporate governance in that space. But no doubt there are clear efforts from the UK government and regulators in the UK to open up the market more broadly. What I would say is that when you're thinking about companies listing in the UK, you also need to think about the liquidity of the market. And clearly FTSE 100 and FTSE 50 are liquid markets, but perhaps not in the same way that you would consider the NASDAQ or the S&P 500 in that space. So, consideration has to be made there. Is it doomed to single-digit growth? No, I don't think so. I think Gary's absolutely right. There are still some very, very decent returns potentially on offer there. It's just about being selective as to where you invest. And in fact, we've started to see a rotation already this year from growth into value. And I think Gary's absolutely right. I think we'll likely see more of that as rates sort of move in a direction of, as we move into a higher interest rate environment. So no, I don't think it's all doom and gloom for the FTSE and for the UK. I think far from it. I think there's plenty of opportunity. I think the government is addressing it. I think it's just a question of finding the right balance.
Great, thank you, Charlie. Gary, I'm going to field this next one to you. It's from Jason Bissell, and it's a question around private as opposed to public markets. And what Jason is asking is how do we expect private equity and debt markets to sort of develop over the next 2 to 3 years?
Yeah, no, good question, because if you read some of the headlines, it feels like a lot of speculative money has gone into the private markets. But to be honest, given the very high valuations that we've had in the public markets, P multiples of up 30 and higher, it's kind of usual that people then start to put more money into the private markets where they believe there's a growth opportunity, and they may be able to pick up things at a low valuation because there's clearly a discovery with these companies as they build up their business plans, and things could just end up with a much more positive spin than an equity market where everything is known. I would say from here, the regeneration of the, I call it the global industrial base, has got to come through heavier capital investment. That's been largely absent. Most of the big companies in the world, and again, I'm a bit of an exaggeration, have been underinvesting. So you're not going to get compounded great returns when companies don't invest in themselves. And many of them have just wasted their capital on buying back stock. The second element is there's some tremendous changes going on in the world. I'm in touch with a few financial services companies that are bringing technology that you just not unheard of, that ends up, pushing the banks out of certain sectors and delivering financial services at a much cheaper price point, dramatically changing the shopping experience, making your FX transactions, costs 25% of what they are today. All of this technology is making a much more efficient financial sector, but many other sectors in technology that, again, it's going to be delivering very surprising growth rates. So when you go to your ordinary equity, you're going to say, the only way I'm going to get to this is through private equity. So I'm just going to finish with one statistic. If you look at institutional funds, so big, heavyweight pension funds, some of those that I used to work for in the past, the typical allocation to venture capital, private debt in the past used to be maybe 5 or 10%. If you look at the major funds today, they're getting up towards 40%. So, to the degree to which a private investor can do things safely in a structured way with the protection of regulation, the allocation to private assets, I think, should increase. But again, with all those caveats, I do think the opportunities are still quite considerable.
Okay, thanks, Gary. So there's been a lot of noise in the investment marketing industry about private markets in the last year or two, and the same could be said of ESG. And we've got a question here on ESG from Martin Sperling, which I'm going to field to Charlie. And Charlie, Martin has said, how much is the swing to ESG investing pushed by central banks and financial regulators in the West, as opposed to a real pull by institutional investors globally that this is the next mainstream long-term rally?
Yeah, it's a good question, and you're absolutely right. You know, it has been an incredibly popular topic in the investment community for coming up to a number of years now. What I would say is it's probably a combination of the two. I would argue, in fact, that regulators have been fairly late in responding to addressing sort of climate concerns and climate change globally. And very sadly, it's you know, as a result of some of the instances we see, such as wildfires in Australia, flooding in Germany, that kind of almost force the issue and try and force their hand. So I would say regulators have been quite slow to respond to it. But it is good to see that it is now attracting more and more attention. And I thought, you know, COP26 in Glasgow last November was a good example of regulators and policymakers worldwide coming together and trying to address it more fully. Now, I think what was quite interesting from that conference in Glasgow, and no doubt the regulators played a significant role in this, was the establishment of a new sustainability standards board. So that's to basically try and establish a global baseline for disclosure standards on climate and other environmental, social and governance matters. So I think that was a good thing and one of the sort of positives to emerge from the conference. I mean, I'll be honest with you, I don't think it was all positive, but for the most part, there's some good developments from it. And that also, what I would say is that also complemented the host, the UK announcement just before COP26 about making companies disclose their climate risks, and that was for large companies from 2022 and will kick in for all companies by 2025. So there are good developments in that space, and that has been pushed by regulators. You know, so to the question, yes, that has very much been pushed by regulators. And I don't think, I would equally argue that the investment community has been a bit slow to respond to it. And yes, we have seen a lot more third-party managers and institutional investors sort of clock onto it. But I think their intentions are good, but no doubt they have been pushed by the regulators. What I would say is that, you know, if you think about the way we invest, you know, the individual investor, they are increasingly putting pressure on their managers to do so. So I would say, you know, it would be very irresponsible of them not to be looking into this space. So there has no doubt been a bit of a push factor by regulators, which has resulted in this pull from the institutional investors. But what I think, how I'd sort of finish that, my answer to this question would be to say that what's important is how we go about, or how regulators, how institutional investors go about addressing climate change. Because at the moment, there are a number of different methodologies used to rate, you know, climate emissions, et cetera, CO2 emissions. So there needs to be a kind of a regulated and a consistent format in how that is done. And hopefully we'll see that through the establishment of an international reporting standard. So I think watch this space. But yeah, no doubt it is a topical conversation, and I think it's gaining good traction.
Thanks, Charlie. Gary, I can't let you go anywhere without sort of talking about China, I think. So quick question on China, and this is from Gary Chapman. And Gary is really sort of flagging up the fact that there appears to be a conflict between the political and economic interests of Western governments when it comes to China. And what he's asking is, how do you see that conflict playing out in terms of its impact on Chinese economic growth, both in the short term and the long term?
Yeah, no, good question. We could be on for the 20 minutes, if not 20 hours. Just a few observations. Interesting that China achieved 8% GDP growth last year, even though the country was closed all the borders. So I think we can never forget that China is a massive internal market that should be benefiting the world. Unfortunately, you know, obviously under Trump and subsequently with Biden, we have this antagonism, which is not going to get the best out of China. And I hate to feel that China just gets ostracized and we feel we can do without it. The growth of the global economy depends crucially on an engagement with China, whether it's providing us with the technology and know-how and whatever in new industries, or it's providing us with a market that we can sell things into. unfortunately, China is not making its country, or the leadership of China is not making it palatable politically for us to have that level of engagement or indeed get a good return. So I think a couple of things on China. One is the asset markets are cheap. So for us, it's a matter of timing as to when we get back in, not if we will get back in. Secondly, and I won't get involved with all of the human rights issues and whatever, but a couple of observations about the Chinese economy. When I showed red blobs and green blobs, you've got to recognize that the level of indebtedness of the Chinese government is substantially less than it is for many other major economies in the world. And of course, at least in China, you've still got some good growth. So, and also you've got a Chinese government, which in a very, ham-fisted ways on some days, is trying to bring about an enormous change in the economy to put it on a sustainable path. No country can continue with massive debt in the corporate and government sector. You have to adjust. China will impose on its country the changes in order to put it on a sustainable path, as much as the changes that we're making at the green level. Charlie talked about ESG. ESG, of course, is a very crucial part of Chinese policy going forward. So again, I'm not asking anyone to fall in love with China or indeed with the regime, but all I'm saying is it's a major part of the global economy. It's going to become the biggest economy in the world in the next 5 to 10 years. It is a major market for big companies that want to be global. And therefore, I think the markets are definitely in scope for investment. I just think we're going to go through another fuzzy 3 to 6 months here. But as I say, we're looking for the buying opportunity after some significant underperformance.
Okay, so just to follow up on that, in terms of the investability of China, you're sort of saying over the next 6 months, potentially some opportunities, and you're comfortable with those GDP numbers from 21?
As much as we've ever been comfortable with the data we get out of China. But look, people tend to it's a bit like we talk about the markets at the moment. Everyone talks about the US and the tech sector. That's not the global world. And if you look at the China situation and you look at what they're doing in their property sector, they're sorting out a mess, but everyone sees it as a failing. And the failing was in the past. The good news is they're trying to correct it. So I think there's a lot of hard work going on to correct the imbalances in the Chinese economy. If they're going to correct those imbalances, they're going to make it better quality. And in making it better quality, more sustainable growth. And if you do that, you will get a good valuation. And I think that an international investor today cannot ignore China because it's in a benchmark and it's quite a heavy weight. At the moment, the majority of international investors are underway. The day they start to go back, as we saw with Hong Kong just over the last couple of weeks, we had days when the market was up 4 or 5% in a day. And that's frightening to international investors. They don't want to be left out of a big part of the components of the index they follow. So as I said, if I said there was a bias of risk for returns in China this year, the bias of risk is a positive one. And therefore, as I said, you should look for the buying opportunity and not feel that you're going to have to chuck it out of your portfolio.
Okay, thanks, Gary. We'll finish off with one more question, which I'll ask both of you actually. Charlie, if you could go first, that would be great. Let's take it close to home to finish off. How do we feel about the case for investing in the UK and sterling more specifically? One of our clients, Alex Von Bear, has also asked us how we feel about the UK relative to Europe. If you do want to say something on that as well, please feel free. But let's concentrate on the UK first, maybe. Charlie.
Yeah, sure. I mean, it's a good question. Obviously, one we've sort of covered to an extent earlier this webinar. But look, I think the UK is in a good spot. I mean, Gary mentioned it's reopening. Whether that looks, in hindsight, looks to be foolish or not, we will see. But it's no doubt a good thing for the economy and for some of the sectors that have been badly hit by the the lockdown, the closures of the borders. So I think, look, from a coronavirus perspective, I think the UK should benefit well from its new policies, coming through in the next month or so. But I also think, look, we've talked about valuations, we've talked about where the US, Gary's talked about how, the markets are now repricing the US, there are higher discount rates within the market. So look, I think more value plays such as the UK, such as Europe, probably do offer good opportunity for investors. Again, we'll see that over time, but we're already seeing a rotation given the current environment and given the shift in narrative from central bankers away from the US, or to an extent away from the US and into the UK and into Europe. So I think that is likely to continue. And if you look at the valuations of the UK in the last few years, it has been what you'd probably say is underpriced. So look, I think there's opportunity there. I think the reopening trade is a good thing for it. It's probably quite good for sterling. The question was also asked about sterling. I think, the Bank of England are deciding soon on whether to start raising rates in February. Now, some are forecasting a 3 to 4 interest rate hike this year from the Bank of England. Now, that's probably quite a bullish indicator for sterling. So, look, I mean, it's always difficult to say. I'm by no means, going to forecast anything. But what I would say is, if you look at the direction of markets at the moment, it should indicate positively for the United Kingdom. And yeah, as I say, I think value is becoming back in vogue, and I think the longer term trends point to it outperforming over the coming years.
Thanks, Charlie. Gary?
Yeah, no, I'd agree. So just very simply, valuation is low, yield is very high. It's one of the highest yielding markets in the world at present. Dividends are still growing. And I think just in terms of the bias of the market, and also we talked earlier about new IPOs and new companies coming to market. The UK is seen as the place of choice for more ESG type companies, and also for the mining sector. So the more lithium and more all the other kind of minerals that we have to pull out of the ground, very often they're getting quoted on that market. And I know that we talk about BP, Shell, Rio Tinto as kind of non-green, but they are trying very hard. Obviously BP's become beyond petroleum, but I do think that the sector bias of the UK could again be very, very helpful to its performance. And I think the wobble that we saw in sterling last year, I think we're beyond that, as Charlie said, supported by higher interest rates without the need for them to become extreme. So within a European portfolio, I think you're overweight the UK. Within a global portfolio, I think comfortably overweight the UK because of the value bias and the cheap valuation.
Anything you want to say relative to Europe, UK relative to Europe?
Yeah, relative to Europe, quite honestly, with the problems in the Ukraine at the moment, it's going to be a safe place to be. But even aside from that, I just think the policymakers have got much more flexibility over the coming 12 months relative to what's going in Europe. I think Europe could end up getting very fuzzy. And also the UK financial sector has not got the same challenges as you see in Europe. So it's not a disaster in Europe, but I just think in relative judgment on those key points, a UK looks more attractive.
Great, thanks, Gary. I'll just say thanks to both of you for your presentation and for answering all those questions for us. Yeah, thanks again, guys. Very good, very good feedback.
Thanks.
So let me leave you with a quick reminder. Let me leave you with a quick reminder of the Fry Group itself. The Fry Group is a UK headquartered tax, financial and estate planner. We were formed in 1898, and we now have offices across all these jurisdictions in the UK, Europe, Middle and Far East. Our mission, if you like, is that we are dedicated to providing an all-encompassing financial planning service that we call Freedom. Freedom is really where we bring all of our planning expertise into one place for the benefit of you, our clients. If you are new to us or you want some help from us at this point, here are all of our contact details from around the world. And it only remains for me to say thank you very much for joining the session today. I hope you enjoyed it. Enjoy the rest of your day. Thank you very much.